Meantime, Saturday was the 2-year anniversary of the bull market, as you may know. Stock prices have risen at the second fastest pace of any bull market since 1950. Our next guest says that while markets are maybe expensive, it's no reason to get super bearish. Piper Sandler Chief Investment Strategist Michael Kantrowitz joins us this morning. Michael, always good to talk to you. I love this line. Markets are expensive, but unless a risk arises, it will stay expensive. Can you talk a bit about that?
Sure. Yeah. I'm sure you guys all the time have people coming on and talking about whether they're bullish or bearish due to valuations. And for sure, pretty much all valuation models have pointed to the market being expensive for quite some time. We always approach this from a catalyst perspective. In other words, trying to understand what's driving multiples. Why have they gone up so much in the last 2 years? And are those trends still in place for further multiple expansion? And so in this case, I think it's, the pricing out of the risks of 2 years ago, inflation, higher interest rates, Fed tightening, that have largely been priced out of equities, which is why the market is largely where it is today. And so going forward, an expensive market is not on its own a reason to get bearish. If we had another spike in interest rates, another resurgence of inflation, or we saw the narrative turn back to recession fears, from any multiple, that would be a reason to get worried. And currently, that's not the backdrop. So I think it's okay for equity markets to remain expensive. But I think investors really want to focus on stocks that have continued earnings momentum, because those names will likely see the best outperformance and can hold those expensive multiples for longer.
Right. And is that going to lead you to any sector in particular?
It's not so much about sectors as it is about individual stocks. And so from a sector perspective, of course, things like tech are expensive. But again, given the compositional issues and single stock overweights, it doesn't really represent the entire group. So the way we would think about it is to dig in within each sector and find the names, even if they're expensive, that still have earnings momentum. So earnings revisions is a factor that we've really been pounding the table on over the last 2 months as a way to start your stock selection screen and build your portfolio from there.
What about higher bond yields? Does that act as a problem at some point?
Yeah, I think so. And things typically act as a problem. First, they show up in leadership before they show up in the broader market. And this kind of reminds me of the beginning of this year, where we started this year, rates were at 380 on the 10-year, and then we went up until April, really with no apparent problem for the equity market until we got to about 430. But underneath the surface, and like you're seeing today, those rate-sensitive stocks and economically sensitive stocks are starting to feel the brunt of that. In the third quarter, the best performing groups were utilities and real estate and small regional banks, all that benefited a lot from lower rates. They're all underperforming and even in some cases down month to date. So you're seeing it in leadership, but it's probably going to take rates going at least to 4.25, in our opinion, to really show up in the broader market.
Meanwhile, there seems to be sort of like buckshot of bullish metrics. For example, rail freight car loads, corporate misery indices, mentions of weak demand. Do you think revisions coming down have overdone it?
Not necessarily. What we often see in a given calendar year is that estimates from the sell side always start out high and then they trickle down throughout the year. What we see consistently is in the fourth quarter, so where we are now in the calendar year, is where you tend to see the biggest acceleration in those downward earnings estimates. Perhaps companies start to talk about the next year and kind of catch up to where earnings are really going to be for the given year. So I would actually expect to see more downward earnings revisions, and that's been the case all year. But again, it's mainly you're seeing it in small and mid caps. Large cap stocks have held up far better in terms of earnings, which is why I think they continue to outperform.
All right. We'll collect more information, obviously, in the coming days. That'll be good to get more commentary, too. Michael, always good to get your take. Appreciate it, as always. Michael Kantrowitz over at Piper.